Hedge trading, also known as hedging, is a strategy used by investors to reduce their exposure to risk in financial markets. In essence, it involves taking a position in a financial instrument or asset that is intended to offset potential losses in another position or asset. For example, let's say an investor has a long position in a stock that they believe will rise in value over time. However, they are also concerned about the possibility of a market downturn or other unexpected events that could cause the stock to decline in value. In order to hedge against this risk, they might take a short position in a related stock, index, or futures contract that they believe will decline if the stock they hold falls in value. If the stock they hold does indeed decline, the short position will generate profits that help offset the losses in the long position. Hedge trading can be a complex strategy that requires careful analysis of market conditions, risk management techniques,